We previously reviewed the importance of using your cash position as a foundation from which to grow your wealth. Today, we cover how to maximize the power of compound interest to multiply your net worth. I'll let the link to the former of this series in the description below, so leave a like, subscribe if you haven't already, and let's dive in. At this point, you have a solid handle on how to manage your money month to month. You've also protected yourself from downside risks and unforeseen circumstances. Only one thing left. It's finally time to go into attack mode and invest your money for growth. And to do that, you'll need a goal and a game plan. You probably already have a goal like retirement or buying something big someday, so today we'll focus mostly on game plan. The main objective of an investor is to double money. Want to know how to double your money? To double your money, you need to get 72% interest. And before you panic, you don't need to get that in 1 year, although that would be nice. Knowing our target interest rate, or rate of return, we now know how to measure the effectiveness of any interest rate that you're considering or currently getting. How do you ask? The simple trick is known as the rule of 72. Here's how it works. 72 divided by the annual interest rate equals the number of years in which this return will double your money. Double, as in turn your 1,000 into 2,000, 100,000 into 200,000, and so on. Remember that local bank savings account interest rate? Well, let's put this 0.01% interest rate to the test. 72 divided by 0.01 equals 7,200. Yep, 7,200 years till that doubles. How about a high yield savings account interest rate of 2 to 3%? Let's try the higher end. 72 divided by 3% gives us 24 years. Okay, guess that beats free checking, aka 0% interest. But these examples were just for the concept. What if we could do much, much better? Like, how can we get to those $100,000 and $1 million plus amounts? We're getting into that next, as well as a few pitfalls that can stop an investor from becoming wealthy. And a quick reminder to like, subscribe, and share if you're getting value from this video. The key word? Assets. An asset is something of value that is owned. Think of stocks, bonds, real estate, even cryptocurrency. Assets can be used to generate income and or be held as they increase in value. Let's check out the stock market, for example. The stock market in its current form has been around since 1957. From then till the end of the last full year, 2021, it has an annualized average return of about 11.88%. Even if you count the absolute beating stocks have taken in the first half of 2022, it's still over 10%. So let's try out our rule of 72. We'll use a flat 10% just to be conservative. 72 divided by 10% means that your money would double about every 7.2 years, or 7 years and 50 days. Now for a side-by-side, the difference between saving and investing. Let's put that 3% up against our 10% over a 30-year time frame. So we start with $0, but we save $300 per month at 3% for 30 years. On a total of $108,000 that you've saved over 30 years, you'd have earned about $67,000 from your 3% interest rate. This leaves you with a total of over $175,000. Not bad, right? Well, how about this? We start with that same $0, but we invest $300 per month at 10% for 30 years. On a total of $108,000 that you've invested over 30 years, you'd have earned over $575,000 from your 10% rate of return. This leaves you with a total of over $683,000. Let's have some fun with this. You want to be a millionaire? Let's try $500 a month instead of $300. On $180,000 total that you've invested, your 10% rate of return earns you over $950,000 $59,000. And you finish with a total of over $1,139,000. What if you started in your 20s and invested consistently for 40 years? Even back down at that $300 a month, a 10% rate of return puts you over $1.9 million. The reality is that the vast majority of millionaires never made seven figures in a single year. They've been compounding their returns over decades, and investing is just another part of their monthly budget. So why doesn't everybody do this? I mean, why not invest from the moment you get your first job to the day you receive your last paycheck? Let me ask you a question. When was the last time you learned any of what I'm showing you right now in school? Got kids? When was the last time they came home and told you about how they've learned to invest their money in class? The first of the three main reasons that people don't invest and become millionaires is simply that they don't know that they can. Not to sound like a conspiracy theorist, but banks and insurance companies don't mind if you're not educated in this regard. They'll gladly give you not even 1% interest on your money, while they make out like bandits with their double-digit rate of return. But stocks are risky, right? Like, they can go up or they can go down. Yes, of course. Let's take a look at a few charts. S&P 500 index. So we're going to go with a day chart right now. Let's see what happened on the last day. It started at 3,993 for the general index and all. It's including the largest, most successful companies. But you see, we finished at 3,924. So it went down. Like, what up with that? Well, that sucks. Let's see a week. We started at 4,036 and we ended up down. Gee, well, it's broken. It doesn't work. You can lose your money, right? Same thing with the month. Down. Year. Still down. But here's where things get interesting. 5 year. Started at 2476, and now look where we are. That's up. In fact, that's over 58% in 5 years. That's more than 10% a year, isn't it? Let's just cut to the chase. Max it out. Looks like they're only going to give us 40 years. So 1982 to, whoa. In 1982, it was 120.42. Fast forward 40 years, and we're at 3,924. That represents over a 3,000% rate of return. All right? Well, that could be all time since 57. It's not really showing me past 40 years, but you get the point. You need some time for the stock market to work. It's going to go up and it's going to go down. But long haul, it's like walking up the stairs with a yo-yo. You'll have your dips, but in the long run, if I were just to draw a trend line from here straight down to here with no fluctuations, would you be more or less comfortable investing? And that's our second reason why people don't invest and become millionaires. Fear. Focusing on the short term, news headlines, wars, and global tensions, things that generally control the market on a sub-5 year timeline. If you let 3 to 5 year problems or 3 to 5 month problems scare you away from your 20 to 40 year game plan, you stand to miss out on some colossal returns. And finally, the last key reason that people don't become wealthy, well, this one's a little different because the people I'm talking about right now do invest. Or they do something like investing. Meme stocks, random pet-faced cryptocurrencies, and other fly-by-night pipe dreams that go up thousands of % overnight. The returns you could get make my 30-plus year examples look like a joke. The problem is these investments, if you want to call them that, can be very short-lived. The vast majority of these will crash to minimal value just as fast as they got pumped up. They'll make a very few lucky people rich, But for the most part, their investors will miss out on those monstrous gains that they were hoping for and actually lose money. Sometimes a lot of money. So how do you navigate these pitfalls and invest successfully? Continue getting knowledge like this, and don't fall victim to get-rich-overnight scams. Focus on your goals and follow your game plan. Stay disciplined, stay consistent, because it's your best shot at getting your money right. Next time, we go into a few practical and specific ways to invest. We'll take a look at a few time-tested, verified millionaire makers. Leave your comments below. Your feedback helps me to improve the channel. Like the video, subscribe if you haven't already, and if you got value from this content, hit the share button to spread the wealth.